Well, thank you for joining us today. My name is Jeremy Joyner. I'm a Senior Wealth Advisor. And with me we have Michael Wellings. He's our Communications Director. We're going to talk about a retirement income planning process today, focused specifically on bear market preparation, bear market processes, and how we deal with the volatility that's inevitable with investing as a retiree. Michael's going to talk about the first part of this presentation, and I'll take over towards the end. So go ahead.
Alrighty, guys. So in our 30 years of being in the retirement planning industry or arena, our firm has really identified 5 really big risks that most people face in retirement. The first is an increased life expectancy risk. Now, 20 years ago, you wouldn't have planned for a 30-year retirement saying that you would live into your mid-90s, but nowadays that's getting to be more and more of a reality. The average life expectancy, I think, now for females is in the upper 80s, and for men it's in the mid to low 80s. So really having that extra cushion and planning for an increased life expectancy is a really big need and a really big risk that retirees face. Another one is inflationary risk, and this is also a risk that everybody faces, but it's just the plain fact that your dollar today is not going to be worth what it is right now 10, 15, even heck 1 year from now. And it's the fact that you need to plan for this inflation to happen. Third is healthcare risk. I've heard it said that healthcare advances are just going through the roof. Unfortunately, so are prices. And that's not poised to go down anytime soon. So planning for healthcare, especially in your advanced years, is going to be a big need. Fourth is market risk, and this is the one that we've been seeing in the past couple of days in particular with the market going down as much as it has. Yesterday, February 5th, went down over 1,100 points. So this is kind of a risk that everybody's quite attuned to at the moment, and it's something that obviously needs to be addressed.
We just put out a video, and hopefully that's why you're here watching this. But the stock market volatility is not something that is easy to forget when you're in the middle of it, but for some reason behaviorally we've learned that folks during bull markets get a little bit relaxed and sort of lose the perspective on the facts that stocks don't always go up. Sometimes they do go down, and when volatility returns, so does the anxiety and the nerves. The fifth one here is providing financial support for other family members. And so Michael, I guess recently we've had several families that are providing for parents. They're providing for boomerang kids that left the house that came back, or in some case, I guess the kids never launch.
Yeah, you're definitely right. And it's not something that retirees can just easily turn down. If you have a kid come back to you and say, "Hey mom, hey dad, I'm in hard times right now and I could really use some help," it's tough to turn down. And so having a plan in place for that possibility is becoming more and more important.
Yes. The traditional approach to retirement income, as we've talked about many times if you've been meeting with us, is that 60-40 asset allocation. 60% of the assets in fixed income or equities, 40% in fixed income. So you go to, we like to say you go to 10 different financial advisors, you get 9 different 60-40s. And the basic philosophy on that is if you take out 4 to 4.5% out, and you're able to increase that with inflation just a little bit, because this portfolio on average might get 6 to 7% rate of return over a long period of time. So if you're only taking out 4 to 4.5, it gets 6 to 7. You do the math real quick. It should grow and hopefully somewhat keep pace with inflation. But we haven't been seeing that working, and certainly during environments where the market is going down, we see stock being sold at inopportune times to produce income. So what are the problems with that approach?
Right, so we've got a few holes that are able to be poked in a 60-40. This traditional approach, it really just doesn't account for the timing of distributions as needed, returns, market downturns as we've seen, or inflation. So this is the one that's on everybody's mind right now, is could you afford to ride out a bear market? Meaning that if you needed the money right now and all your money's tied up in stocks and you need that money, you're going to have no choice but to sell it. So can you afford to ride out a bear market with a 60-40 portfolio with your needs as you need them right now? The second one being the inflation risk that portfolios have. Can you handle inflation for the long term? The third being what happens if disaster strikes. Houston knows this very well. We just had Hurricane Harvey last August. If you were somebody whose home was affected and you didn't have insurance on that home, you know how expensive it was. And if you're on a fixed income and disaster strikes, it's not good news. And last but not least, will your portfolio be able to provide for long-term care? As people age, long-term care becomes more and more of a necessity, and it's something that needs to be provided for.
So what's our solution? We've talked about this a lot, and this really is hopefully why you're on this or reviewing this presentation. Our solution to particularly the bear market problem, the volatility we're experiencing, is let me just get this off the table. It's certainly not market timing. We are not out there trying to predict when the market's going to do well and when it's going to do poorly. That's a quick way to make lots of mistakes and lose lots of money as an investor. What we're trying to do is use time to our advantage to allow things to grow. So when you own stocks, we believe you should not own a stock if you need the money within the next 6 years or so. So that's what stage 1 is for. Stage 1 is to provide income for the first 6 years of retirement. Stage 2, income in years 7 through 12. Stage 3, years 13 through 18, and 4, 5, and legacy. So we stage out everybody's retirement. Now, if you've been a client for 10 years, you're probably not in stage 1, you're in stage 2, or even longer, maybe you're in stage 3. That's kind of irrelevant, because what we want to have, is about 6 years of income out of the markets right now. So yesterday, markets down 1,000, almost 1,200 points on the Dow. If you are in our process like this, what you need for income right now was not and should not have been affected, or if it was affected, it was just slightly. So that gives those investments, those latter stages, stages 4, 5, and legacy, and 3, 4, 5, and legacy, time to recover as they're affected by the volatility. Here's an example of how we divide out a typical portfolio, where you have stage 1 in 0% stock all the way to legacy in 100% stock. So yeah, the legacy, stage 5 and 4 and 3, those are going to go up and down with the markets. Lately it's been mostly up. Yesterday, definitely down. But you have ideally time to ride out the storm. Now, a lot of folks are saying, well, how much time do you really need? Well, on average, we have a bear market every 4 to 6 years. And if you look back historically, the longest bear market we had, or that at least we track, was about 1946, lasted about 3.5 years, took about 3 years to come out of that. So a 6-year period, and that's why we like to earmark 6 years of income. So ideally, we want to address these market risks with this process. Now, let's say you're not in retirement income mode and you're viewing this presentation. If you have the time horizon 6+ years to rise, so let's say you're 45 years old and you're preparing for age 65 retirement, you've got 20 years. I mean, as long as you've got a good asset allocation, and if you're a client of ours, it certainly should be, you should not be that concerned with short-term volatility. Treat that as an opportunity to invest, buy things when they're a little cheaper, not as a place of fear to make a big mistake. So our process is really designed to address market risk, cost of living through inflationary pressures, increased life expectancy. We've talked about all this before. We wanted to focus specifically on market risk today and providing a legacy for your family. I'm going to click through a couple slides here, but this is an example of how we go about building and monitoring a plan. So we go through this preliminary planning process, which really drives the need. And that's what's so critical to understand, is we did not bury our head in the sands when we built your financial plan thinking that we wouldn't have any difficult markets. Not true at all. We definitely accounted for that with this process. So an overall asset allocation, so as you're in this process, is typically around 50 to 60%. Some folks are a little bit more aggressive than others, but still, if you don't need the money today, relax, take a deep breath. There's a process in place. We'll get through this storm.
Yep. Wiser words have never been spoken. In conclusion, everybody, would like to thank you for your time and your attention. Hopefully feel a little placated after this discussion. If you do happen to have any questions, comments, concerns after watching this video, please reach out to us and let us know. We'd like to talk to you more about this. If you have any concerns, if you have any questions about where you're at right now, give us a call, 713-977-3800. Also, feel free to peruse the rest of our website, askstrategicadvisory.com.
Yeah, there's a video that I did about 2 weeks ago, I guess this was right before the whole market correction began, But about 2 weeks, and I discussed this process on the whiteboard through our week in review video. Check that one out too. We've got tons of blog posts on how to deal with bear markets and things and topics such as that. And I thank y'all for your time and your attention. I thank Michael for his participation and development of this, and we certainly look forward to hearing from you.